Should we be concerned? Do you think inflation is just around the corner? And where does that leave market bubbles as well?
Right. The bottom line is that I think it's more likely to have asset price inflation than consumer price inflation, even though we might have a short-lived consumer price inflation in the spring. But I do think despite the magnitude of the fiscal package, $1.9 trillion, I think that we are, the inflation burst that we might see in the spring will be short-lived. Why is that? Because I think, there's still some consumer anxiety. I also do not think that commodity prices will feed into core prices. And with regards to the Fed, actually, what you see is that when money goes into financial assets, it doesn't go into the real economy necessarily. So I'm actually quite serene about the inflation risk. However, two things to mention. One is that if there were a further infrastructure package, I think then we could start looking at a different equation. And point number two is that we still have to be worried about the confidence and the trust in the financial system and in economic policy making, because there's a buildup of debt. Confidence so far is actually quite strong, even though you see at the edge of the system some gradual erosion in confidence. But confidence is still there. But things can turn on a dime there, and we need trust in the financial system, and we have to be careful with economic policy making, not going too extreme.
Thomas, what we have seen in the last couple of weeks as market rates have spiked, it has taken some of the excess out of particular stocks and parts of the market where there's been rapid momentum in recent months. I want to ask you about the outlook then from here, because it feels as though we could be in for a couple of bumpy quarters on this bounce back recovery story, a little bit like what we saw last year when we saw a plunge in some of the demand numbers based on the services economy being largely shut. It doesn't feel like normal numbers are going to come through. We're going to get a spike potentially as economies open up, and then a bit more normalization, maybe more spikes down the road. How do market rates weather that storm that could be coming?
Well, regarding long-term rates, I think what's going on right now is that there is, the bond market is testing the Fed. Jerome Powell 2 days ago was quite serene about long-term rates. Yesterday, he showed a bit more cautiousness by mentioning, those 3 years, insisting on 3 years before at least 3 years before the first rate hike. So he starts to lean against the rise in long-term yields, but he may have to do a bit more. The bond market may again test the Fed, in my view. Now, I do not think the Fed's tolerance to the rise in long-term yields is that elevated. The U.S. economy has a lot of debt. It's very sensitive to long-term rates. I think the Fed will start to lean against the rise in long-term yields more than it has in the past few days. Also, we need the housing market. So if you see a strong rise in long-term rates, you could see a bumpy road ahead for the housing market. So I think that's also another consideration. And to come back to your point about the bumpiness of the recovery, yeah, I think it will be bumpy. There'll be stop and go in the reopening, especially until we get full vaccination, which is still not expected before the summer. And also, bumpiness also coming from financial market movements, including long-term yields.